Employers don't want people to be their employees. Well, I don't have to make anybody an independent contractor anymore. All I've got to do is give them a profits interest.
No, partners are not considered employees, so the partners must take care of their own federal income tax.
The up-and-coming thing is going to be understanding how to deal with the LLC entities.
Okay, members of LLCs are exempt from workers' comp insurance.
We reviewed the fact that the LLC members were not considered to be employees.
Yes, partners, owners are not required. You're not required to have coverage on the partners.
Welcome to Closely Held Businesses, Innovative Planning Strategies and Techniques, held June 26th through the 28th, 1997 in Chicago.
Think about what a lot of small businesses have tried to do. There's been a lot of tax litigation. Employers don't want people to be their employees. They don't want to pay wage withholding taxes. They don't want to pay the employer FICA tax. They don't want to pay unemployment compensation and the whole other dizzying array of employee-related payroll taxes. They fought this battle at the independent contractor line. Well, I don't have to make anybody an independent contractor anymore. All I've got to do is give them a profits interest. The profits interest is in my LLC or my limited partnership or my general partnership. And the profits interest can stand in line way back, and I can have an employee who makes $10 or $20 or $50,000 a year whose profits interest may never produce more than $100 a year or $1,000 a year. And yet, by the wave of this magic wand, I've eliminated all my payroll withholding and payroll tax liability.
You are either an employee or an independent contractor. At least conventional wisdom holds that. Except here is the chairman of the American Bar Association's Business Tax Section and professor of tax law at Chicago-Kent Law School, Professor Sisk, suggesting a third option, the partnership exemption. And that's what we're going to be exploring, Professor Sisk's partnership option. Essentially, he's pointing out that a business organized as a limited liability company can distribute a small profits share to the employees, even just 3 to 6%, for example. This results in a conversion of an employee into an exempt partner and eliminates many employee-related costs and regulations like withholding, FICA, unemployment, workers' compensation, Form I-9, payroll costs, the Oregon New Hire Report, and OSHA. Before we move too far, let's get some background on what a limited liability company is, what a partner is, and where did the limited liability company come from? It's kind of a new thing, isn't it?
A partnership is an unincorporated business that is the result of 2 or more persons joining together to carry on a business. Each person contributes money, labor, or skills, and each expects to share in the profits and losses. A partnership's income and expenses are generally reported on Form 1065, an annual information return. No income tax is paid by the partnership itself. Each partner receives a Form 1065 Schedule K1, which allocates the income and expenses among the partners according to the terms of the partnership agreement. Partnership.
Alright, and this is the fundamental definition. If we jump onto the web at 1065accounting.com, it's a good place to get some information and some good forms. They will again repeat the standard definition. The last portion of this definition we're going to be concentrating on. Each shares in the profits and losses. This is going to affect most of what we're talking about, so I want to point it out and highlight it. And this is the basic definition of what a partnership is, the concept of sharing the profits. Let's call the IRS's tele-information line and choose the definition of limited liability company.
Welcome to the Internal Revenue Service Teletax Information Line. A limited liability company with more than one owner is treated as a partnership for tax purposes.
But there's one element in which the IRS Tele-Information Line did not mention, and if we bring up the instructions for IRS Form 1065, here we can read the key characteristic of the limited liability company. Unlike a partnership, none of the members of an LLC are personally liable for its debts. So essentially, the limited liability company is a new type of partnership organization. Before we move on to the story of the limited liability company, let's first hear the story of its sister entity, the limited liability partnership.
The limited liability partnership actually grew out of the failed savings and loan debacles of the 1980s. It was actually started up by the national accounting firms who decided that they did not care to be sitting in Chicago and be responsible for the opinion letter that went out from some partner in Seattle who they've never met. And these partnerships have literally over 1,000 partners. So they decided that we should obtain some of the same protections that our friends the lawyers are getting, and that we don't want to be responsible for the malpractice of our co-partners unless we were part of that participation. And so the limited liability partnership statutes have come about.
Well, the story of the limited liability company has some of the same origins. It turns out that Hamilton Brothers Oil Company of Denver, Colorado needed a new entity that was much like the corporation in that it limited the liability only to the entity, not to the partners. And they approached Pete Marwick Mitchell and Company in contact with the Wyoming Chief Justice, Walter Urbicite. They wrote that we attempted in 1977 to create this new company, but it wasn't until 1980 that the IRS responded. In 1988, the IRS finally relented with a ruling letter that LLCs would be treated as partnerships, not as corporations, which don't have the favorable taxation. And it was in this letter that A.J. Miller, the Chief Financial Officer and Executive Vice President from Hamilton Brothers Oil Company, mentioned that they needed an entity that would not be taxed as a corporation, but rather would be taxed as a partnership. And it was with the assistance of Pete Marwick Mitchell and Company that this new type of entity was created. It was Mr. Frank Burke, in cooperation with Hamilton Brothers Oil Company's General Counsel, Mr. Coates, who drafted the initial Limited Liability Company Act, which was presented in 1977 in front of the Wyoming legislature and passed without changing a single comma or period. And in 1977, the Limited Liability Company was introduced to the United States. Pete Marwick Mitchell and Company is not known by that any longer. The P for Pete and the M for Marwick are the P and the M in KPMG, one of the Big Five. And now, you know the rest of the story. Using the partnership organization as a mechanism for sharing profits, it needs to be distinguished from employee-owned businesses, in which the employees own stock in the corporation, such as Round Table Pizza. United Airlines was an employee-owned business until 2002, and TWA Airlines was an employee-owned company until about 1999 when it merged with American Airlines. There are several employee-owned companies here in the Northwest as well.
Stop by your employee-owned Bi-Mart and discover the Bi-Mart advantage.
And Winco Foods is also an employee-owned company now. There's another one in which you're probably familiar with. It's a local company.
I've been working here since 1992. My dad introduced me to the company.
Miller Paint is our paint. Employee-owned, employee-operated. Miller Paint, our paint.
Still though, all of the employees merely own stock in the corporation. They're not partners or members of a limited liability company. About as close as you can get using a corporation would be the Indian casinos. Each of the Indians has a partial ownership in the operation. Right. Each of the tribal members has a share in the corporation. But stock in a corporation does not make you a partner in a partnership. And that's the distinction to be made.